Here's the most counterintuitive truth in trading. Your smart profit taking is slowly murdering your account. The widely accepted wisdom that feels safe, grabbing profits early, is actually the silent assassin of trading accounts. While you celebrate those quick $200 wins and post screenshots of green trades, you're behaving like a casino that shuts down the blackjack table the moment it starts winning. Think about that paradox. Every successful business understands one fundamental principle. Let probabilities work in your favor over time. Yet 90% of retail traders do the exact opposite, snatching profits at the first sign of green while holding losers, hoping they'll come back. It's financial suicide disguised as prudent risk management. This is where profit anxiety destroys accounts. The moment your trade moves $500 in your favor, something sinister happens. Your heart rate spikes. Dopamine floods your system. The mind screams, "Take it before it disappears." You start calculating what that money could buy. A nice dinner? Part of a car payment? Something real instead of these fake numbers dancing on your screen. So you close the trade. You feel smart, responsible, disciplined. You've locked in profits like every guru taught you. But here's the brutal reality. You just made the worst possible decision. That same trade you clipped for $500? It runs another $2,000 over the next 3 days. But you'll never see that money because you've conditioned yourself to grab crumbs instead of claiming the full meal. This creates a devastating identity crisis. Are you the profit snatcher who trades for emotional relief, or the trend operator who trades for systematic outcomes? Stop pretending these are the same. One feeds your nervous system with quick dopamine hits. The other feeds your equity curve with asymmetric returns. The market operates exactly like a casino, but not how most people think. The real house edge doesn't come from rigged games, it comes from patience. Casinos don't panic when someone hits a royal flush. They don't close the poker room after a few losing hands. They understand that probabilities need sample size to work in their favor. But retail traders act like a casino that shuts down every time a customer wins. They're so terrified of giving back profits that they guarantee they'll never capture the moves that actually matter, the asymmetric outliers that fund entire months of expenses. Here's your mirror test. Open your trading journal and ask, do my average winners actually outgrow my average losers? If not, your identity is lying to you. You call yourself disciplined, but your behavior screams gambler, seeking the micro hit of certainty instead of the macro payoff of patience. The stakes aren't just financial, they're psychological. Continue down this path, and you'll experience the death of 1,000 cuts, small wins that feel good in the moment, but slowly erode your capital through inevitable big losses that you'll hold because it has to come back. You've trapped yourself in a spread. Small wins, standard losses, and occasional meltdowns when you revenge trade the runner you clipped too soon. Your equity curve flatlines while you feel busy and productive, but you're really just spinning your wheels in financial quicksand. By the end of this series, you'll understand the invisible metric that separates consistently profitable traders from the perpetually struggling masses. You'll learn why "you never go broke taking a profit" is the most dangerous lie in trading. And you'll have step-by-step protocols that make holding winners feel systematic instead of terrifying. But first, we need to confront that sacred trading slogan head-on and run the numbers you can't unsee. Because if you believe you never go broke taking profits, you're already on the fast track to account destruction. So here's your commitment. The next time you're up modestly, ask yourself, am I cashing out to feel safe or holding because my premise is still intact? That single question can add zeros to your account over time. Ready to see the mathematical proof that changes everything? You never go broke taking a profit. This sacred commandment of retail trading isn't just wrong. It's the most expensive lie ever whispered in trading forums. I'm here to shatter that comfortable delusion with cold, hard mathematics. You absolutely can go broke taking profits, and it's happening to traders right now while they celebrate their disciplined approach. Let me introduce you to Sarah, a trader who embodies everything the gurus teach. She maintains an impressive 80% win rate, religiously takes $50 profits, and prides herself on never getting greedy. When trades move against her, she gives them room to breathe and typically cuts losses around $200. Sarah feels professional, posts green screenshots, and lectures others about capital preservation. Here's Sarah's brutal reality over 100 trades. 80 wins at $50, each equals $4,000 in profits. 20 losses at $200 each equals $4,000 in losses. Net result before commissions? 0. After fees and slippage, she's bleeding money while maintaining her impressive win rate. Sarah is celebrating her way to account destruction, one disciplined trade at a time. This is death by 1,000 cuts in action, the phenomenon where high win rates slowly murder accounts through mathematical ignorance. You feel competent all day and broke at month's end, trapped in the most insidious cycle in trading. Frequent small wins that feed your ego, while occasional large losses drain your account. Why does this pattern persist? Neurochemistry. Every $50 profit triggers a dopamine hit, flooding your system with the same chemicals that create gambling addiction. Your brain learns a simple equation. Click out early equals feel good now. This positive reinforcement hijacks your process, creating an addiction to the very behavior that guarantees long-term failure. Meanwhile, you're holding losers because giving back real money feels worse than watching paper losses grow. You've inverted the fundamental rule of trading. You're cutting winners and holding losers, all while feeling disciplined and professional. Here's your casino reality check. When a high roller wins big at blackjack, does the house panic and shut down the table? Never. They understand that their edge plays out over thousands of hands, not individual sessions. They let probabilities work in their favor through sample size, never cashing out on small advantages. But retail traders operate like a casino that celebrates every $5 chip while panicking at every $200 loss. You're optimizing for the frequency of feeling good instead of the magnitude of actually winning. You've become the house that closes the profitable table, guaranteeing you'll never realize your statistical edge. This creates two distinct species of traders. The scalp addict hunts micro moves all day, feels incredibly productive, and measures success by activity rather than outcome. They're always busy, always grinding, always feeling like progress is being made. But their equity curve tells a different story. Lots of small greens, periodic big reds, and a slowly declining account balance. The asymmetric hunter operates differently. They might make one trade per week, sitting patiently for setups with massive reward potential. When they strike, they capture moves that fund months of expenses. They optimize for outcome, not ego validation. They understand that trading isn't about being right frequently. It's about being right asymmetrically. Stop measuring success by how often you win. Start measuring it by how much you make when you win versus how much you lose when you're wrong. That ratio, not your win percentage, determines whether your next 100 trades will pay you or punish you. The slogan survives because it protects feelings, not capital. It lets you feel risk-averse while quietly assuming the most dangerous risk of all, ensuring your winners never outgrow your losers. You're trading away the rare outliers that could carry your entire quarter for the certainty of a small emotional pat on the head. If this sacred wisdom crumbles under basic arithmetic, what does the actual math reveal? What's the invisible equation that separates consistently profitable traders from the perpetually struggling masses who mistake activity for achievement? The mathematical proof that changes everything is coming next. Are you ready to see the expectancy equation that will destroy every comfortable trading myth you've ever believed? Here's the mathematical equation that will destroy every comfortable trading myth you've ever believed. The expectancy formula doesn't lie, doesn't care about your feelings, and reveals exactly why most traders fail despite following conventional wisdom. Expectancy, win x AVG win, loss x AVG loss. Expectancy, win x AVG win, loss x AVG loss. Let me show. You two traders with identical setups, identical 45% win rates, and identical 1R stop losses. The only difference? How they handle winners. Trader A clips profits at pleasure point 5R the moment they feel safe. Trader B holds until their premise breaks, averaging plumps 2R winners when they're right. Trader A's math, expectancy 0.4505, 0.5510, 0, 225.0, 550, 325R expectancy 0.4505, 0.55 for 1.0, 0, 225.0, 580, 325R Trader B's math, expectancy 0.452.0, 0, 1.0, 0, 90, 0, 55.0, 35R expectancy 0.45 being 2, 0, being 1.0, 0, 90, 0, 55.0, 35RR. That's the difference between slow death and systematic wealth building. Trader A has negative expectancy, guaranteed account destruction over time. Trader B has positive expectancy, guaranteed wealth accumulation over the same period, same setups, same risk management, opposite financial destinies. Now watch this play out over 100 identical trades. Both traders risk $100 per trade and face the exact same market sequence. Trader A results: 45 wins at $50 each to $2,250 in profits, 55 losses at $100 each to $5,500 in losses. Net result, $3,250. Trader B results: 45 wins at $200 each for $9,000 in profits, 55 losses at $100 each, and $5,500 in losses. Net result, $3,500. The difference, $6,750 in wealth transfer from the impatient to the patient. But here's where it gets devastating for early exit traders. In that same sequence, Trader B captures 3 outlier moves that run to plus 3R and 2 monster trends that hit plus 5R. Those 5 trades alone generate $3,400 in profits, more than Trader A's entire winning streak combined. This isn't theoretical. Meet Marcus, a day trader who tracked every decision for 6 months. His journal revealed the brutal pattern: 78% win rate with $47 average winners and 183 average losers. He felt successful all day and broke at month's end. Marcus's expectancy: on Burr 7 takes 47, 7.10 to 183, 36, 66 and 40, 26, 3. 6 expectancy 0.78 47, 0 to 183, 36, 66 40 29 3, 6. Every trade Marcus made cost him $360 in expected value. The more he traded, the faster he went broke, but he felt disciplined because he was taking profits. Then Marcus implemented holding protocols. He doubled his average win to $94 while maintaining the same average loss. His win rate dropped to 65%, but watch the transformation. Expectancy 0.65 vanities, 0.35 Sunday 83, 61.1, 64 Davir 2, 95 expectancy 0.65 94, 0.35 183, 61.1, 64 Nevi Ben 2, 95 still negative but improving. 3 months later, his average win reached .56 expectancy 0.6 times 156, Nari got near 83, 101, 4 to 64.05 Bales 37, 35 expectancy 0.65 Bams 156, year 35 ND3, 101, 4 to 60 year did 37. 35 Marcus transformed from losing $360 per trade to making $37.35 per trade. Same setups, same stops, same trader. The only change, he stopped sabotaging his winners. His equity curve went from declining to ascending. The mirror reveals an uncomfortable truth. The market wasn't Marcus's enemy. His nervous system was. Every time a trade moved in his favor, his biology screamed, "Cash out now." Evolution programmed him to grab immediate rewards instead of waiting for asymmetric outcomes. But professional traders understand something profound. Trading isn't about conquering markets. It's about conquering yourself. The expectancy equation reveals why patience pays and impatience kills. But knowing the math isn't enough. You need a mental model that makes holding winners feel logical instead of terrifying, systematic instead of scary. What framework do professional traders use to override their biological programming and execute with mathematical precision? Here's the mental framework that separates professionals from amateurs. The sniper's mindset. A military sniper doesn't celebrate pulling the trigger. That's just the beginning. The real skill is in the follow-through. Maintaining sight, picture through recoil, tracking impact, staying ready for the next shot. Amateur shooters flinch, jerk the trigger, and look away before impact. Same weapon, same target, completely different outcomes. Trading mirrors this perfectly. Amateurs enter positions and immediately start planning their escape. Professionals enter positions and execute complete trade plans with disciplined patience. The entry isn't victory. It's commitment to a systematic process that unfolds over time. This requires a powerful visualization, your equity curve as an expectancy spine. Picture your monthly profits supported by vertebrae, each one representing a plus 2R, plus 3R, or plus 5R winner. These outlier trades are rare, maybe 5 to 8 per month, but they carry the entire structure. Your dozens of small wins and losses? Just soft tissue around the spine, important for daily function, but the spine determines whether you stand tall or collapse into a shapeless blob. Clip those big winners early, and you've severed your own spine. Your equity curve loses structural support and crumbles under inevitable losing streaks. But let those outliers run their full course, and you've built an unbreakable foundation for wealth creation. The sniper's job is protecting that spine through the 3-clock system. Every position operates on 3 simultaneous timers, and survival requires all 3 to keep running. The setup clock asks, is my original premise still valid? If you bought a breakout and it's trending higher, the clock keeps ticking. If you bought support and it's holding, stay patient. Only when the setup premise breaks do you consider exit. The risk clock monitors. Has my maximum adverse exposure been hit? This is your predetermined stop level, nothing more. Risk management isn't about comfort. It's about mathematics. If your stop hasn't triggered, this clock keeps running. The profit clock tracks. Is the trend tail still unfolding? This is where amateurs self-destruct. They mistake normal pullbacks for trend endings and abort positions just as the real move begins. This clock only stops when clear reversal signals emerge, not when you feel nervous. But here's where psychology becomes everything. The teacher market administers 3 brutal tests designed to separate amateurs from professionals. The anxiety test strikes first. You watch your position move from plus 0.3R to plus 1R, and your nervous system floods with stress hormones. Every cell screams, take it now. This is wealth transfer in action, from the anxious to the patient. Next comes the patience test. Your winner pulls back to break even after touching plus 2R. Doubt creeps in. What if I give back these gains? Amateur traders cave here, closing positions to avoid uncertainty's discomfort. The final exam is the greed test. Your position hits plus 2R and pushes toward plus 3R. Now greed joins fear. This is already great. Don't get greedy. Even experienced traders often fail here, trading away life-changing moves for certainty's comfort. Watch this play out. Marcus enters a clean breakout, risks plus 1R, watches it move to plus 0.8R, then pull back to 0.1R. His finger hovers over the close button, but he checks his clocks. Setup intact, stop not hit, trend still unfolding. He holds. The trade reaches plus 3R by close, funding his entire week. That single decision rewired his identity from profit snatcher to trend operator. The sniper understands something profound. These uncomfortable feelings aren't warnings, they're confirmations. When your position makes you nervous, that's exactly when holding becomes most valuable. The discomfort signals you're positioned for the wealth transfer that only patient capital captures. You're not predicting markets, you're preparing for probabilities. You're not chasing action, you're waiting for permission. And when the shot is on, you follow through because your equity depends on a few strong vertebrae, not 1,000 tiny ribs. But mindset without systems fails under pressure. How do you translate this framework into concrete protocols that work when your hands shake and your heart races? How do you engineer an environment that blocks sabotage while preserving flexibility? The hold protocol is next. Get ready to build your cockpit. Understanding the sniper's mindset means nothing without systems that execute it under pressure. This is where the hold protocol transforms conceptual clarity into behavioral consistency, a comprehensive framework that removes emotion from exit decisions when your hands shake and your heart pounds. The protocol operates on 3 critical levels that protect your expectancy spine from self-sabotage. Before every trade, you build premise architecture. Define your entry reason in one clear sentence. Break out above resistance with volume expansion. Invalidated if we close back below the breakout level. Not vague hopes, but specific conditions that guide future decisions. Next, map your R ladder before risking a dollar. Plan your stops, targets, and trail points. 1R, stop where the idea dies. Plus 1R, first alert. Plus 2R, scaling consideration. Plus 3R, trail activation. This isn't prediction. It's preparation for systematic execution under pressure. Create if rules that eliminate discretionary panic. If the trade reaches plus 2R with continuation signals, hold for plus 3R. If it hits plus 2R with reversal patterns, scale 50%. If it pulls back to 0.5R after touching plus 2R, hold unless my stop triggers. Program your future self to act mathematically, not emotionally. During active positions, environmental control becomes everything. Hide live P&L displays immediately. Your brain cannot handle watching dollar fluctuations without triggering fight or flight responses. Use R multiples instead. Seeing 1.2R creates mathematical decisions, while Pudge 200 creates emotional ones. Set automated alerts at predetermined R levels. Let technology notify you when decision points arrive, instead of watching charts obsessively. This creates crucial psychological distance between analysis and execution, preventing the emotional momentum that builds during constant monitoring. Implement weight filters that block impulsive reactions. Feel the urge to exit early. Set a 15-minute cooling timer. Most panic-driven impulses fade when you step away from the screen. If you still want to exit after the timer, you've at least interrupted the fear response and can make a more rational decision. For trend-following positions, activate the bunker method. Close social media, avoid trading forums, ignore financial news. External noise creates doubt about positions that are working perfectly. Other traders' opinions become psychological poison when you need conviction most. Set specific check-in times, end of day next morning, rather than constant monitoring. Install commitment devices that create friction against sabotage while preserving systematic exits. Some professionals physically remove their mouse during crucial holding periods. Others use platform settings that require multiple confirmations for position changes. The goal isn't paralysis. It's blocking emotional decisions while enabling planned ones. After each trade, focus on process analysis, not profit outcomes. Rate your protocol adherence. Did I follow my IFT then rules? Did I execute my R ladder plan? Where did emotion attempt to override logic? This debriefing reinforces systematic behavior over immediate gratification patterns. Track rule adherence percentages alongside P&L results. Professional traders often achieve profitability by improving rule adherence from 60% to 80% without changing their strategy at all. Reward yourself for following the protocol regardless of trade outcomes. This rewires your brain to value process over profit. The small account objection reveals fundamental misunderstanding. I can't hold big winners. I need the cash. Fixed fractional risk management keeps emotions manageable regardless of account size. Risk number 6% of a $5,000 account, $50, or 1% of a $500,000 account, $5,000. The psychological pressure should be identical if you're managing risk properly. The relative impact on your account remains constant, so the emotional experience should too. Small accounts benefit most from holding winners because they need asymmetric returns to grow meaningfully. Clipping winners at +R guarantees you'll stay small forever, trapped in the cycle of small profits and standard losses. The hold protocol isn't about ignoring market signals. It's about systematically engaging with them on your terms, not the market's emotional whims. You're building a cockpit where you pilot with discipline instead of clinging to controls in panic. But theory crumbles under market pressure. How do these protocols perform when news whipsaws your position? When price chops sideways for hours? When clear trends suddenly reverse? Time to stress test this framework against the scenarios that separate amateurs from professionals. Real battle conditions are coming next. Time to stress test the hold protocol under live fire. Theory sounds elegant in calm markets, but real trading happens when volatility spikes, your position whipsaws, and panic floods your nervous system. These three scenarios separate amateurs from professionals every single day. The news whipsaw trap. Both traders enter a clean momentum breakout, risking 1R with clear premise, continuation above resistance with volume expansion. 30 minutes later, unexpected economic data hits. Price jumps to plus 0.8R, then immediately reverses on a massive red candle, wicking down to plus 0.1R in seconds. Trader A panics instantly. This is news-driven chaos. Anything can happen. He slams the exit button, protecting himself from uncertainty's discomfort. Flat. Safe. Relieved. 10 minutes later, he rage watches the move rip to plus 3R as algorithms finish their tantrum and the original momentum premise reasserts itself. Trader B activates wait filters immediately, steps away from the screen, checks his 3-clock system. Setup clock still valid, momentum intact, above resistance. Risk. Clock untouched, stop never approached. Profit clock indicates noise, not reversal. He holds through the teacher market's anxiety test and captures the full plug 3R move. The difference? One optimized for emotional comfort, the other for systematic execution. Same chart, opposite bank accounts. The chop filter challenge. Both traders enter a marginal breakout that immediately stalls. For 90 minutes, price churns between 0.2R and 0.3R, grinding patience while offering zero directional conviction. Trader A force holds, confusing stubbornness with discipline. I'm already in, so I'll ride it out. His premise is clearly broken. No momentum, no follow-through. But sunk cost fallacy keeps him trapped. Eventually stopped out for 1R after 2 hours of psychological torture. Then revenge trades the same dead zone. Trader B applies the 2 failed legs rule. After the second attempt to break higher fails and price returns to break even, he recognizes premise invalidation. This isn't a pullback, it's premise death. EO exits at plus 0.1R, preserving capital and emotional bandwidth for actual opportunities. Professional insight. Holding winners doesn't mean holding everything. Intelligence distinguishes premise intact pullbacks from premise broken failures. Trend day mastery. Both traders recognize textbook trend day conditions: gap up, immediate follow-through, relentless directional bias. Multiple opportunities emerge throughout the session. Trader A enters scalping mode. 5 quick profits, plus 0.4R, plus 0.3R, plus 0.5R, plus 0.4R, plus 0.3R. Total, plenty on R. He feels incredibly productive, posting screenshots of disciplined exits. But he's exhausted by close, having spent 8 hours managing micro-moves while missing the forest for individual trees. Trader B recognizes trend day characteristics and adjusts his profit clock accordingly. Continuation signals persist throughout the session. He rides 2 major legs: morning momentum to plus 2.5R, afternoon extension to plus 2.5R. Total, plus 5R with 2 decisions instead of 10. The math is devastating. Trader A worked 5 times harder for half the profit. His scalping guaranteed he'd miss the asymmetric moves that make trend days profitable. These scenarios reveal the 3 pillars that most traders never develop: discipline, following rules under pressure; patience, waiting for proper signals; and resilience, maintaining conviction through drawdowns. But here's the deeper truth. These aren't strategy differences. They're identity differences. Both traders used identical setups, identical risk management, identical market analysis. The only variable was who they believed themselves to be when pressure mounted. Trader A operated from profit gambler identity, optimizing for immediate emotional relief. Trader B operated from trend operator identity, optimizing for systematic wealth accumulation. Your trading results aren't determined by your strategy. They're determined by your identity under stress. The hold protocol worked because Trader B had already chosen his identity before the market opened. When chaos struck, he didn't need to decide who to be. He already knew. But identity isn't fixed. It can be consciously chosen and systematically developed. Time to facilitate the fundamental transformation that makes holding winners feel natural instead of forced. The shift from gambler to operator begins now. Who do you choose to be when the charts turn red? Your trading problems aren't technical, they're identity-based. Every morning, two distinct identities walk into your trading platform, and only one can survive. The profit gambler optimizes for emotional relief and immediate gratification, asking, "How much can I make right now?" The trend operator optimizes for systematic execution and probabilistic outcomes, asking, "What does my system require in this situation?" Same charts, completely different neural pathways driving decisions. The profit gambler treats every trade like a slot machine pull, seeking dopamine hits from quick profits. They celebrate small wins like lottery tickets, post screenshots for validation, and measure success by frequency of feeling good, rather than magnitude of wealth creation. Their trading becomes a series of impulsive reactions to P&L fluctuations, driven by the primal need to convert fake paper profits into real money. The trend operator treats every trade as a business transaction with predetermined rules and mathematical expectations. They celebrate rule adherence regardless of individual outcomes, understanding that consistency creates wealth, while cleverness creates chaos. Like a restaurant owner who doesn't celebrate every customer or mourn every empty table, they optimize systems for consistent profitability over time. This transformation requires internalizing the operator's creed, 5 identity-reinforcing beliefs that elite traders use to maintain consistency under pressure. Discipline is my edge. I follow protocols under pressure because hesitation kills accounts. Patience compounds profit. The teacher market rewards those who let lessons finish unfolding. Risk management precedes return optimization. I am a risk manager who happens to trade. Expectancy trumps ego. A few plus 3R and plus 5R vertebrae carry entire months. Process determines outcome. Perfect execution of a losing trade builds wealth. Sloppy execution of a winner destroys it. But let's address your deepest fear. Looking foolish when held, winners reverse. This terror drives more profit clipping than any technical analysis ever could. You'd rather grab small certain gains than risk appearing greedy if winners become losers. Here's the reframe that changes everything. Executing predetermined rules always looks professional, regardless of short-term outcomes. Following your R-ladder demonstrates systematic thinking. Holding through normal pullbacks shows probabilistic understanding. Getting stopped out after systematic execution proves proper risk management. Amateur behavior is changing rules mid-trade for comfort. Professional behavior is executing plans despite discomfort. Develop strategic detachment by viewing individual trades as business transactions rather than personal validations. Your P&L is a scoreboard, not a reflection of your worth. This detachment requires daily cultivation through specific practices. Before charts open, declare your session identity. Today, I am a trend operator executing predetermined rules. This primes your nervous system for systematic behavior instead of reactive gambling. When profit anxiety strikes, implement tactical breathing. 4 counts in, hold 4 counts, out 4 counts. This activates your parasympathetic nervous system, shifting from fight or flight to analytical thinking. Operators breathe, gamblers panic. Limit exit considerations to predetermined times. Market open, lunch, close, rather than constant monitoring. Schedule your doubt instead of letting it run wild through every price tick. After each trade, rate rule, adherence from 1 to 10. Reward high scores regardless of profit outcomes. This rewires your brain to value consistency over immediate gratification. Share your daily plan with a trusted peer before the open and your debrief after close. When eyes are on your process, you respect your process. Use visible scoreboards tracking rule adherence percentages, not just P&L. The transformation isn't instant. It's intentional. Every time you choose systematic execution over emotional relief, you strengthen operator neural pathways while weakening gambler patterns. Your identity becomes whatever you consistently reinforce through daily decisions. But why endure this uncomfortable transformation? Why fight natural impulses for immediate gratification? Because the compound effect of operator identity doesn't just change your trading. It transforms your wealth in ways that justify every moment of discomfort. The mathematical and psychological payoff that validates this entire identity shift is coming next. Get ready to see why patience pays exponentially. Here's the mathematical payoff that justifies every uncomfortable moment of your identity transformation. The compound effect of exponential patience doesn't just improve your trading, it creates wealth that makes the entire struggle worthwhile. Consider two traders starting with identical $50,000 accounts. Both risk 2% per trade and maintain identical 45% win rates over 100 trades. The only difference? How they handle winners. Trader A clips profits at +1R average, feeling disciplined and safe. Trader B holds systematic winners to +2.5R average, enduring the anxiety of watching profits fluctuate. The math is devastating. 45 wins EPS $1,000 each, 55 losses at $1,000 each. Net result, $10,000. Final account, $40,000. 45 wins EPS $9,500 each, 55 losses at $1,000 each. Net result, $67,500. Final account, $107,500. Same trader skill, same market conditions, $16,750 wealth transfer from impatient to patient capital. But this understates the real power of exponential patience, understanding that the majority of trading profits come from a small minority of trades. In Trader B's sequence, 8 moves extended beyond +3R into true asymmetric territory. These 8 trades alone generated $32,000 in profits, more than half his annual returns. Remove these outliers and both traders show similar mediocre results. The difference isn't skill or strategy. It's the discipline to hold when every instinct screams, "Take it now." This reveals the power law distribution that governs all trading profits. Your entire year might depend on capturing just 2 or 3 major trends. Miss them by clipping early, and you guarantee mediocrity regardless of technical expertise. Capture them systematically, and you unlock compound growth that transforms accounts into wealth. Meet Jennifer, who proved this transformation is achievable. Year 1, $25,000 account. Early exit patterns, flat performance, despite 70% win rate. She felt busy and productive, but stayed broke. Year 2, same setups, same risk management, but systematic holding to +2R minimum. Account grew to $41,000. Year 3, refined protocols captured 3 major trends averaging +4R each. Account reached $78,000. Jennifer's exponential curve contrasts with Mark, who maintained identical technical skills but continued early exit patterns. His equity curve remained flat over 3 years, trapped in the cycle that guarantees stagnation. But what about small accounts? This objection reveals fundamental misunderstanding. Small accounts need asymmetric returns even more desperately. A $5,000 account generating 15% annually stays small forever. The same account capturing 2 +5R moves per year transforms into serious capital within 5 years. Fixed fractional risk keeps emotions manageable. Risk, $50 on a $5,000 account or $500 on a $50,000 account. The relative pressure remains identical. What about choppy markets? Operators adapt expectancy, not identity. In ranging conditions, they reduce position sizes, demand cleaner setups, and accept fewer trades. They preserve emotional capital until the teacher market shifts back to trending conditions. The framework scales to any environment. What about gaps and violent reversals? This is why premise-based trailing exists. When your setup clock dies, not when price twitches, but when the original idea breaks, You exit systematically. The 3 clock system protects you from both premature exits and stubborn holding. Enter the asymmetric advantage, how professionals position themselves to capture tail events while managing downside risk. They use core and satellite positioning. Hold core positions through full trend development while trading satellite positions around the edges. This captures both systematic returns and tactical opportunities without sabotaging asymmetric exposure. Scale into strength, never weakness. Add to positions only when unrealized profits have paid the original risk, pyramiding at +1R or +2R, with stops ratcheted so total exposure never exceeds your original risk percentage. Let winners prove themselves before increasing exposure. The revelation that changes everything. Trading isn't about predicting markets. It's about positioning yourself to benefit from inevitable asymmetric moves that create generational wealth. Markets will always produce outlier moves. The question is whether you'll capture them or clip them. Your identity transformation from profit gambler to trend operator unlocks access to compound growth that turns trading accounts into investment portfolios, side hustles into primary income, and financial stress into financial freedom. 1 plus in 10R month funds a quarter. 2 such months fund a year. A single multi-month trend captured with discipline can change your financial baseline for the next decade. But understanding compound mathematics means nothing without implementation systems that work under pressure. How do you bridge the gap between knowing these concepts and executing them consistently when your hands shake and your heart pounds? The 30-day transformation roadmap that turns exponential patience into muscle memory starts now. Get ready to build the environment, rules, and repetitions that make holding winners feel automatic instead of agonizing. Understanding exponential patience means nothing without systematic implementation. The gap between knowing these concepts and executing them consistently when your hands shake and your heart pounds is where most transformation attempts die. This 30-day roadmap bridges that chasm through weekly phases designed to rewire decades of profit-clipping conditioning. Build your cockpit. Your first week focuses entirely on environmental design before risking a single dollar. Configure your trading platform to hide live P&L displays, replacing dollar amounts with R multiples only. When you see pumps 1.2R instead of PO1 $200, your brain makes mathematical decisions instead of emotional ones. Set automated alerts at predetermined levels, +1R, +2R, +3R, rather than watching charts obsessively. Install commitment devices that create friction against sabotage. Platform settings requiring multiple confirmations for position changes, or physical separation between analysis and execution spaces. Create your hold protocol templates, premise, definition worksheets, R ladder mapping forms, if-then rule frameworks. Practice completing these for paper trades until the process becomes automatic. Your future stressed out self will execute whatever systems your calm current self builds. Daily practice involves 30 minutes each evening, reviewing historical charts, identifying entry points, mapping R ladders, and noting where early exits would have cost asymmetric returns. This builds pattern recognition without financial pressure. Mechanics under minimal pressure. Begin live implementation with 0.25R risk per trade, half your normal size or smaller. The goal is practicing hold protocol mechanics without overwhelming psychological pressure. Small stakes let you experience real emotions while keeping consequences manageable. Focus purely on rule adherence, not profit outcomes. Rate each trade's protocol execution from 1 to 10. Reward high scores regardless of financial results. This rewires your brain to value consistency over immediate gratification. Implement the 3 clock system religiously. Before every exit consideration, check all 3. Setup clock still running? Risk clock untouched? Profit clock indicating continuation? Only exit when at least 1 clock stops ticking. Practice weight filters aggressively. Every impulse to exit early triggers a 15-minute cooling timer. Step away from screens? Breathe tactically using 4-count cycles, then reassess. Most panic-driven urges fade when you interrupt the emotional momentum building through constant monitoring, resistance, and sabotage management. Expect your nervous system to rebel violently. Week 3 typically brings intense resistance as old patterns fight for survival. Profit anxiety intensifies. Self-sabotage attempts multiply, and every held winner feels like psychological torture. This is normal. You're rewiring decades of conditioning. Common sabotage patterns emerge. This setup looks different today. I should take some profits to be safe. The market feels unstable. Recognize these as your profit gambler identity's death throes, not legitimate analytical insights. Install accountability systems immediately. Share daily plans with a trusted peer. Before market open and debrief after close. When eyes are on your process, you respect your process. Use visible scoreboards, tracking rule adherence percentages alongside P&L results. Troubleshoot specific obstacles systematically. Getting stopped out frequently? Examine premise definitions for clarity. Still clipping winners despite protocols? Reduce position sizes further until holding feels manageable rather than terrifying. Identity reinforcement. Through consistency, begin cementing trend operator identity through consistent execution and process-focused metrics. Your nervous system should start accepting that holding winners is your new normal, not an uncomfortable exception. Requiring willpower. Expand position sizes gradually only as rule adherence improves. Increase risk to 0.5 R per trade only when you consistently score 8 or higher on protocol execution. This ensures your systems can handle increased psychological pressure without breaking down. Track progress metrics that reinforce identity transformation. Percentage of trades held to predetermined targets, frequency of premature exits, prevented by weight filters, emotional regulation scores during winning periods, and plan match rate, comparing actual exits to predetermined rules. Celebrate process victories over profit outcomes. I held through a +1R pullback because my setup clock was still running. These small wins compound into identity transformation more effectively than celebrating dollar amounts. This transformation is a process, not an event. You're developing new neural pathways while weakening old ones that have operated automatically for years. Be patient with yourself as your brain adapts to prioritizing long-term wealth creation over short-term emotional relief. Progress metrics become your new scoreboard. Rule adherence percentage, 3-clock alignment at exit decisions, hold to target ratio, average R multiple per winner, and emotional regulation counts. Expectancy improves when these scores rise, even if P&L lags temporarily. By month's end, holding winners should feel systematic rather than scary, logical rather than forced. You'll have built the behavioral infrastructure that captures asymmetric returns while managing downside risk through disciplined protocols. But implementation systems are just tools. The final element that determines whether you unlock systematic wealth, creation, or remain trapped in mediocrity is a fundamental choice about who you are when the charts turn red and your profits fluctuate. That choice, the moment you stop gambling and start operating, determines everything that follows. We've reached the moment where everything crystallizes. Every loop we opened, every paradox we exposed, every comfortable myth we shattered has led to this single choice that will determine your trading destiny for the next decade. Let's close every loop we created together. We began by proving that taking profits early, the wisdom that feels safe, is actually the silent assassin of trading accounts. We demolished the dangerous myth that you never go broke taking a profit, with undeniable mathematics showing how traders with 80% win rates slowly bleed accounts dry through the death of 1,000 cuts. We delivered the expectancy equation that separates consistently profitable traders from the perpetually struggling masses, proving that your average win versus average loss determines everything. We introduced the sniper's mindset and the 3-clock system, transforming you from an anxious profit snatcher into a disciplined trend operator who protects the expectancy spine of plus 2R, plus 3R, and plus 5R vertebrae. We built the Hold protocol, comprehensive behavioral systems with weight filters, environmental design, and commitment devices that remove emotion from exit decisions when pressure mounts. We stress-tested these frameworks against the scenarios that separate amateurs from professionals: news whipsaws, chop filters, and trend day mastery. Each scenario reinforced the truth that your results aren't determined by strategy differences. They're determined by identity differences. We facilitated your transformation from profit gambler to trend operator through daily practices that rewire decades of conditioning, showing you how to develop strategic detachment and systematic execution under pressure. We revealed the compound effect of exponential patience, demonstrating how capturing just 2 or 3 major trends annually creates more wealth than hundreds of clipped profits. Finally, we provided your 30-day implementation roadmap, breaking the transformation into manageable phases that address predictable resistance and sabotage attempts. Now everything distills into your operator's manifesto, 3 core principles that will either guide every trading decision or remain forgotten concepts. Patience is profit. Time is your greatest ally, not your enemy. The teacher market rewards those who let lessons finish unfolding instead of interrupting them for emotional relief. Your job isn't predicting the future. It's positioning yourself to benefit from the inevitable asymmetric moves that create generational wealth. Every moment of discomfort while holding winners is compound interest accumulating in your favor. Discipline is edge. Consistency trumps cleverness every single time. Your edge isn't a secret indicator or magical entry signal. It's your unwavering commitment to systematic execution under pressure. Perfect execution of a losing trade builds wealth. Sloppy execution of a winner destroys it. The market doesn't reward the smartest analysis. It rewards the most disciplined execution. Hold your winners. This tactical imperative transforms everything. Your entire equity curve depends on a few strong vertebrae that carry entire months. Clip them, and your spine collapses. Let them run through systematic protocols, and you build unbreakable wealth infrastructure. The ability to hold winners is the single most valuable skill for long-term trading success. Your choice is binary and permanent. Remain a profit gambler, forever chasing small, immediate gratification while missing life-changing trends, or evolve into a trend operator who systematically compounds capital through patient, disciplined execution. The profit gambler path feels comfortable. You'll celebrate small wins, post green screenshots, feel productive through constant activity. But you'll stay trapped in the cycle of small profits and standard losses, forever wondering why your account doesn't grow despite all your effort and knowledge. The trend operator path feels uncomfortable initially. You'll endure profit anxiety, resist the urge to clip winners early, hold through normal pullbacks that test your conviction, but you'll capture the asymmetric moves that fund months of expenses, build exponential equity curves, and transform trading from side hustle to primary wealth vehicle. Here's your tactical implementation system. Before every session, set your mantra. Premise, risk, profit, check the clocks, protect the spine, trust the math. When your cursor hovers over the exit button, recite this before making any decision. When news hits and candles scream, ask, has my premise broken, or is this noise? When chop forms, remember the 2 failed legs rule. When trend days appear, trade less and hold longer. Make 1 micro commitment today. Hold 1 winning trade to its first planned target without watching P&L. That single repetition begins rewiring your nervous system. Tomorrow, do it again. End of week, grade yourself on discipline, patience, and resilience. Post your score publicly and ask for accountability. Your transformation requires community. Share your biggest insight from this journey in the comments below. Declare publicly whether you're choosing the gambler path or operator path. State 1 specific rule you'll follow for the next 30 days. Tag someone who needs to hear this message. Join the community of traders making this same identity shift, supporting each other through the uncomfortable but necessary process of rewiring decades of conditioning. The market operates on one simple principle that most traders never internalize. Extraordinary results require extraordinary patience. Those who learn this lesson compound wealth systematically. Those who ignore it remain trapped in mediocrity despite their technical knowledge and analytical skills. Your choice determines everything that follows. The charts are waiting. Your equity curve is watching. The teacher market stands ready to reward those who show up with discipline, patience, and the courage to hold their winners when every instinct screams to take the money and run. Choose wisely. Your future self and your future wealth depends on the identity you select right now.